It looks like the economic picture is pretty positive in Canada heading into the new year. While the economy continues to be growing, it is growing at a slower pace.
The U.S. economy starts the year from a position of strength. Growth has been resilient, and the often forecasted recession hasn't happened. Corporate profits are expanding, inflation has come down a good deal over the last couple of years, and the central bank is moving toward a less restrictive monetary policy.
So there's lots to monitor for the Canadian economy heading into the new year. We need to keep an eye on the momentum behind economic growth here in Canada. And there are a number of wildcards that we need to be watchful of as well. The proposed tariffs on Canadian goods by the US president certainly have very negative consequences for the Canadian economy. 1/3 of our GDP is made up of exports, and roughly 80% of our exports go to the US market. So the oil companies, the auto companies, et cetera, will face major headwinds that will have a negative impact on our GDP. We need to be mindful of the impacts of a weaker Canadian dollar because that has the chance of importing inflation into our economy. When you also look at the population growth, which is actually expected to decline now over the next couple of years, given the pivot in the immigration policies by the government, we know that that will act actually as a headwind to the Canadian economy as less goods and services are demanded by new immigrants. So all of these things are reminders that having diversification in the portfolio is a wonderful thing.
Inevitably, the outlook is bound to be impacted by the election results and the policies that may follow from the Trump administration. We expect a large fiscal package that will include a slight reduction in the corporate tax rate. There'll probably also be some further tax incentives for small business. And there will be an aggressive approach to deregulation, particularly in the areas of energy and the environment. And Donald Trump really fired the starting gun on tariffs back in November. And that's the issue that could be a game changer for the economic outlook. Applied selectively and tactically, tariffs can be implemented without a major macroeconomic impact. But sweeping tariffs applied across a wide swath of products and countries would, in our view, potentially have a boomerang effect on the U.S. economy with a kind of a stagflationary outcome. We'll be paying very close attention to the new administration's approach to tariffs. We know they're coming, but the key questions are where, how much, and for how long.
So the outlook for fixed income really rests on how the inflation picture will unfold. While we're comfortably in the middle of the target that the Bank of Canada has set out, we know that any spark of inflation could really change the course for the Bank of Canada. And so I don't think we're ready to declare the battle completely over on inflation yet. We know that volatility will rise in the bond market should we see any revisiting of the inflation story. But bond market volatility is very normal in the market over the last 10 years. If we look at the volatility of the bond market as a whole, it's roughly 5.3% per year. And this is in the safe asset class. It's very important to remember that if you look out over the long term, the returns that you're going to receive will look a lot like the yield that you're starting with. And the real danger only happens in any given year when you're starting with low yields and entering an environment when you're facing rising interest rates as well. Bond yields today are actually significantly higher than their long-term averages over the last 15 years, and we're entering into a rate declining environment. So we think the setup for 2025 is actually quite attractive for bonds, and the yields today represent a good entry point.
Well, if you sort of start with the bond market, I think the analysis there begins with the Federal Reserve. We would expect another 0.5% to 1% of cumulative cuts over the course of 2025. So that means short to intermediate term yields have some room to come down. It's a little bit more complicated with longer term bond yields, though. Bond investors will have an eye on the fiscal policy debate that goes on in Congress, focused how it all might impact the enormous U.S. government debt load. So it's possible we don't see any decline in long-term bond yields at all, net over the course of 2025. And in terms of the stock market, you have to start start by saying that the U.S. equity market is squarely in a bull market. The S&P 500 just completed 2 years in a row of annual returns well above 20% in each year. And the economic environment suggests that the bull market should continue in 2025. Profit forecasts look strong. In terms of a cautionary note, I guess you could say that the S&P 500, which is comprised of the largest companies in the U.S. economy, carries a somewhat lofty valuation compared to history. So we expect much more muted returns than the big results that we're seeing in 2023 and 2024. But there are more attractively valued parts of the equity markets, such as mid-cap and small-cap companies, where there may be more material upside in 2025.
The U.S. market has captured all the attention being the strongest performer, but Canada is not that far behind. We've got the interest rate environment as a tailwind at our backs, along with continuing strength in the Canadian economy. And when we stack up the Canadian market versus the U.S. market, we're relatively cheaper on a valuation basis, relatively higher dividend yielding than the U.S. market. When we stack ourselves up against the developed European markets and Asian markets, we see that the Canadian market looks a little expensive relative to those markets, a little bit lower dividend yielding as well. And so having a blend of different geographies in a portfolio makes a lot of sense.
Fundamental outlook for the economy and markets is rather positive in the U.S. for 2025, but we have to keep a very close watch on policy developments.
So the key takeaway for investors is really to stay focused on the long term. Volatility is a natural feature of the markets. Over the long run, we know that the intra-year declines in the US stock market, for example, averages out to about 14%. And yet over the long term, the returns of equities have been solidly positive. When we look out over 20-year horizons, we can't find a rolling period where equity returns are negative. No matter what happens in 2025, no matter what the headlines say, it's important to stay calm and invested and focused on the long term and compounding great returns.